Slow the hell down. You're going way too fast. You're analyzing deals. You're showing us case studies, and you're just breezing through comps and income and expenses and metrics. And you said cap rate like 20 times already, and I have no idea what you're talking about. Don't worry. I just like to throw you in. That's kind of how I like to teach people, right? Is throw you in, let you learn, give you a little bit of a shock, and then pull you out of the water, wrap you in a warm towel, pad you dry, and just put my arm around you, and we'll kind of take a walk and talk and learn how to swim properly, right? So before we get into the good, all the ways that you make money with rental property, we'll talk about actually what you're looking for when you analyze a rental property's financials, because that's probably the most important step. Analyzing the financials. Don't worry about all the stuff on this sheet right now. Just chill for a second. Analyzing the financials is the first step that we take towards evaluating whether a property is a good deal or not. Why is it the first step and not condition or not tenants? Because this is where usually most deals, God, where's my English? This is where most deals usually fall apart. So we push the most likely disqualifier to the beginning of the qualification process. So we analyze the financials first. Taking a look at all these numbers, by the way, this is my, if you haven't seen it before, if you haven't been introduced formally, my legendary Invest with Ace rental property calculator. It wasn't meant to be legendary, it just went viral on social media and everyone bought it. You probably already have it if you're here at this course because you spent more on this program than you did on the deal calculator, and everyone likes to buy this thing and play around with it. So let's talk about some of the key metrics you're going to pull out of a financial analysis for a rental property, for a basic rental property, something like this. This is just a random fourplex in Louisville, Kentucky. I say Louisville, and I get corrected by the locals to Louisville every single time. It's down the street from a property that I own, not too far off from a property that I personally own. And the reason I've handpicked this as an example is because it's a clean 1970s fourplex in a reasonably priced working class neighborhood that's going to cash flow all right and is in pretty good condition. Something that a lot of you would probably pursue as maybe a first or second or third deal after completing this program. So we're going to use it as an example here. And we're going to pop on over to this rental property calculator and show you some of the key fields that you're going to be thinking about as you analyze the financials or as you watch me analyze financials over the course of this program. So the first important bit is the sale price. Obviously, a lot of these metrics that you see in these pro forma analyses and everywhere else that we'll talk about later in the next slide are going to come from this sale price. And they're also going to come from the property's income, right? So I've called this unit breakdown. It's really an income section. It just allows you to enter all the individual apartments and then how much they're currently renting for and what they're potentially able to rent for. So current income could include current rents. It could include laundry facilities that you'd add under here. It could include additional garage spaces that are not already baked into the rent. It could include storage spaces. It could include late fees and application fees, although those are annualized, not monthly, really, right? Not every month at least. Maybe the late fees might be for every month on certain tenants. So you're going to want to include all the property's income in here. Every single bit of it. If you have like a full year worth of late fees and leasing fees, I'd put it in here as full year and then divide it by 12 to get an average. But anyways, I shouldn't go that far. All the property's income going to go in this section right here, and then you're going to factor in all the property's expenses. Expenses don't count mortgage. This is a common misconception. Debt service is not an operating expense. An operating expense is something that you would have to pay for to continue to run your property even if you owned it free and clear. So these here are operating expenses. Like the cost of operating a business, basically, right? It doesn't include the loans that the business has to pay back. Property tax, insurance, owner paid gas and electric, just the owner paid portion, not the tenant paid portion, right? We'll show you how to find out the difference between the two. Owner paid water bills, sewer bills, trash bills, lawn and snow care, property management expenses. And then these two down here, vacancy and maintenance, these are reserves. What do I mean by reserves? Well, you're not going to always have the exact same vacancy cost and maintenance cost every month. So what you do is you average out what you can expect to pay over a year or over multiple years of ownership, and then you spread it over a monthly reserve. Now, this isn't a real expense, right? This is just a budgeted expense. So what you should be doing is in a month that you don't have vacancies, you should be taking the vacancy reserve amount. Maybe it's 5%, maybe it's 10%, maybe it's 15%, whatever you choose. You should be taking this vacancy and maintenance reserve amount, putting it in a separate account elsewhere. for this particular property and planning to spend it over time. And if you don't, good for you, right? If you have enough cash stored away from all the property's cash flow, then you don't have to go ahead and keep holding on to this vacancy maintenance reserve. You could say, hey, you know, once I have 10,000 in an account into reserves, I'm going to take all the profits after that. But make sure to factor in expenses that aren't regular as well, like vacancy and maintenance. And these aren't every possible expense. Maybe you have pest control that you bake into the maintenance cost. Or maybe you add a separate line for it, right? Maybe you have an HOA that you want to add into this lawn and snow cost, because that's kind of what it covers, right? Or maybe you want to add a separate line for it. But there are going to be potentially other expenses. These are just the most common. The next big cost or reduction from cash flow is going to be debt service, your mortgage payment essentially, right? And what's your mortgage payment made up of? Well, really it's all about the total mortgage amount, which is the purchase price minus your down payment. So you put 20% down, well then your mortgage is going to be 80% of the purchase price, right? The interest rate, how long the loan is, so basically the amortization schedule, the term of the loan, and when you have to have it paid off by, in this case it's 25 years. And factor in some upfront closing costs too, but really it's just these three things that determine how much your mortgage payment is. And once you plug in all your income and expenses and your debt service and your sale price, your calculator or your own manual calculations, if you choose to do this on paper, you know, or in your own spreadsheet, they'll spit out some key metrics. The first key metric is going to be your monthly net operating income. What is that? Well, you take your gross rents, right? All the income you collect for the month. You're going to subtract all those operating expenses. Remember, this does not include your debt service. Total operating expenses here are $1,506.67. Rents are $3,180. The net income after that is $1,673.33. If you own this property free and clear with no loan, you'd be collecting $1,673.33 a month after putting reserves aside in net operating income. Now you want to annualize that number for a lot of calculations. What does that mean? It's just this times 12, because there's 12 months in a year, right? So after a full year of 1673, you're making $20,080. And to figure out your capitalization rate, which is a really important metric, you're going to divide this annual net operating income by the purchase price of the property. This could be the price that the seller's asking that you choose to calculate it against. It could be the price that you desire to purchase it at, or you'd like to purchase it at, right? You can have cap rates for both. But the sale price that you ultimately bought it for is going to be what goes in here, right? Whether it's, you know, one that got negotiated or you just paid full asking. You're going to divide net operating income annually by the sale price. You're going to get a capitalization rate. Now this is expressed as a percentage. Remember, if you don't multiply it by 100%, then it's going to be a 0.0618 decimal form, right? It's just a little bit of 7th grade math here. But 7th grade was a long time ago for me, so I forget this stuff all the time. So 6.18 is your cap rate. What is this cap rate? What does it mean? Well, this is the percentage of your property's value that it would return back to you every year if you owned it free and clear without any debt service, right? Why is that important? Well, investors tend to value properties by their capitalization rates, right? They go, hey, you know what? In Louisville, Kentucky, in this particular neighborhood, Pleasure Ridge Park, I know it sounds like a high school drama, right? But in this particular neighborhood, Pleasure Ridge Park, we expect the property to have about a 6 cap, right? Investors will buy 6 caps in this neighborhood. Well, you've got yourself a 6.2 cap with 6.5 cap upside. That means your property returns more than what most investors are willing to purchase in this area, which makes your property a slightly better deal than other deals in this marketplace. Now, if investors say, hey, in this particular neighborhood of town, I'm only buying 7 caps. If you look at recent sales, and they're all 7 caps, you can get the income and expenses, right? Or you're looking for a 7 cap, and this property is only a 6.2 occurrence with a potential 6.5 upside, then it's not as good of a deal as the comparable properties nearby. It brings in a lower capitalization rate, right? So that's why cap rate's important. You can raise rents and you can then raise the price to make the cap rate go lower, and you can go as low as you think you'd sell the property for, and you can try to flip this thing, right? So capitalization rate is basically a valuation metric, but it also happens to tell you how much you make if you don't have a loan. Now, if you do have a loan, your cash flow is going to be calculated after the mortgage. So how do you do that? Well, you take your monthly net operating income, and then you subtract your monthly mortgage based on the rate and the terms that we discussed. So you can see the sale price is $325. You've got the loan amount of $260, which is reverse engineered out of this down payment number, right? And the sale price. You've got your interest rate of 4%. You've got a 25-year term. The mortgage is $1,372. Your monthly net, $1,673 minus $1,372 is about $300. That's your monthly cash flow. That is money that goes straight into your bank account after paying everything off. That's $3,600 a year of annualized cash flow. And your return on investment is this annualized net divided by your total down payment, because you didn't invest $325 in this property, you invested $65, 20% of it down to buy this property. And after all your payments, you're collecting $3,600 of free cash flow, money that's yours, essentially. And that's a 5.56% return on this $65K investment. Now, once you raise the rents to $3,300, assuming all the expenses are in line with what you have here, then your cash flow goes up to $390, $46.91 a year, and a 7.2% return on investment as far as cash flow goes. So that's the key set of metrics when you're analyzing a property's financials. Now, you might ask, why the hell would I invest in a rental property like this, wherever it went? Come on back. Like this, or like that one that I showed you, wherever it was. All right, why would I buy a fourplex like this that's going to take effort and stabilization and stress and a down payment up front that's pretty big, right? I can't just invest $5,000 and get a fourplex like this just to make a 7.22% return. We'll talk about that in the next slide. There's more than one way you make money in your investment property. That's going to be the encouraging part. So don't just worry about this cash flow. There's a lot of reasons not to just stick this money in the S&P 500.